Hey, welcome back. In this video, we're going to talk about charitable giving, and specifically in retirement, we're going to look at how to do this in ways that can save you the most in taxes. When somebody gets to retirement, you may not know it, but you actually have some additional ways of giving to charity that were not available to you during your working year. So we're going to go into what that is and look at some examples. You can see, dollar for dollar, how that works. So what we're talking about here are Qualified Charitable Distributions. You've probably read about these. They're called QCDs for short. So in this video, as I refer to it as that, you'll know what I'm talking about. And essentially, what a Qualified Charitable Distribution is the ability to give directly from a pre-tax retirement account, like an IRA, and take a distribution from there and send it directly to a public charity. Now, this is helpful because, as you may have noticed, when you give to charity, oftentimes you're not even able to claim that deduction. Because itemized deductions are higher than they've been in the past, what will happen often is somebody will give to a charity, and even when you add up all the other things you can itemize, like mortgage interest or your state and local income and property taxes or medical expenses even, after you add up all of those things, you may not actually get any benefit from those deductions because you'll end up just taking the standard deduction anyway because it's higher. Even more so because when you're in retirement, once you reach age 65, if you're married, you and your spouse are entitled to take a higher standard deduction. And if you're a single filer, equally, you're able to take a higher standard deduction. So it kind of raises the hurdle as far as how much you would need to give to charity in order to have a tax benefit. Okay, so this is where Qualified Charitable Distributions enter the picture. After you reach 70 and a half, you are able to take a distribution directly from an IRA and send it to a charity. Now, when you do this, you're not able to claim it as a charitable deduction in the itemized deduction section. But where this is beneficial from a tax standpoint is that by sending it directly from your IRA to a charity, it doesn't hit your 1040. You do not have to recognize it as income. Because of that, it amounts to an above-the-line tax deduction. So we're going to look at some examples. You can see exactly what I'm talking about. And this will be helpful because another reason why this is so powerful is that it impacts how much your Social Security is taxed. Social Security tax rules, or I should say, Social Security has its own special taxation rules. And so those rules, it's called the provisional income rule. And the very short explanation of provisional income is that your Social Security taxation is determined by how much other income you have. And so by doing a charitable distribution that removes income from your broadly other income, then it can impact how much of your Social Security is taxed, and it can reduce that amount. So, for example, you could have $10,000 go to charity, and so that's $10,000 less that shows up for your income. But because that impacts Social Security potentially, maybe your total income goes down by $15,000 or $16,000 or $20,000. So it's kind of long-winded. Let's jump into the examples because it's a little hard to kind of grab your head around until we actually look at the number. So on the screen here in front of us, we're looking at a retired couple. Husband is 73, wife is 69, and let's go through and look at their sources of income so you can get an idea of what we're talking about here. All right, let me get out my little box here. Okay, so this is scenario one, and in this scenario, this is going to be the couple giving to charity in the way that they usually do, just trying to itemize. And in this scenario, we're going to look at everything exactly the same, but they're going to do a qualified charitable distribution. Okay, so starting with income, you can see that over here we have taxable interest, qualified and regular dividends, all the same for both of, for under both scenarios. Now, the next box here, you'll see we have IRA distributions. And in scenario one, you can see here they're taking out $40,000 from their IRA for income. In scenario two, they're taking out $30,000 as a regular distribution and an additional $10,000 that's going directly to charity. So a total of 40, but it's broken down like this. So in both scenarios, now we're looking at Social Security. This is where we're going to see the impact of provisional income, how that actually impacts the whole tax equation. So for Social Security, for this couple, they're bringing in a total of $65,000 a year in Social Security, $45,000 for the husband. He had a higher income working career, and the wife is bringing in $20,000 from a spousal benefit. Okay, so here's the power. When we look at taxable Social Security benefit, you can see that in scenario 1 of the $65,000 Social Security benefit, $36,175 is subject to tax. And in scenario 2, only $27,675 is subject to tax. So we're going to reduce income by this $10,000 here, but then because we reduced all the other income sources, the provisional income rules come into play, and it reduces the amount of Social Security subject to tax. So we're taking off, I don't know the math here, maybe an extra, $8,500 is being subtracted from their overall taxable income. So let's scroll on down the page and see kind of how this works out. So now if we look at total income, they have the same dollars coming in both scenarios. It's the same economic benefit they're receiving. But in this scenario, total income, $83,175, and in scenario 2, $64,675. So significantly less being taxed. In both scenarios, they're going to end up taking an itemized deduction. And let's break it down. So you might think, hey, well, in scenario 1, they're going to give $10,000 to charity. That will probably, be beneficial. And in this scenario, you can see that, well, they've got state and local income taxes, $2,500 in each, $3,000 of property taxes. And I'm doing this for the state of Utah. That's where I live, but these rules are, we could look at it from state to state and you could see that, this is going to be beneficial basically every time. Okay, so total state tax deductions here, we got $5,500. Come on down here to charity. So in scenario 1, we're going to put down the $10,000 they're going to give to their church. And in scenario 2, you can see we don't get to claim the $10,000 again because it's going out as a QCD directly out of the IRA to the charity. You can't double claim it, there and here. So you just claim it in the one spot. Now, as you can see though, in both of these scenarios, they're going to end up taking a $32,300 standard deduction. And so, in this scenario, even though they gave the $10,000, it doesn't increase their deductions at all, right? Now we get here to taxable income. Scenario 1, these retirees will be paying taxes on $50,875, and in scenario 2, they'll be paying taxes on $32,375. And that's because you took I'm going to scroll back up here. We took their total income, then their adjusted gross income. And in both these scenarios, we're subtracting the $32,300 to get to their taxable income of $50,875 and $32,375. Okay, so federal taxes. This retired couple paying $52.81, and in scenario 2, paying $3,061. Savings here of $2,000 and $2,150, something like that. Over $2,000 being saved, not for giving extra to charity or anything like that. It's just simply the way that they pay charity. Now let's go down and see how it impacts this retiree for their state taxes. Now this is where it's going to be different from state to state because every state tax code, the way that tax calculation is done is a little bit different. So for federal, it's across the board the same, but for state, it's going to be different. And in the state of Utah, it's particularly helpful for income taxes. So we'll come down here just all the way to the bottom, and you can see that for state taxes, this retiree in scenario 1 is paying $1,000, and in scenario 2, they're paying $115. So overall, for this retired couple, every dollar counts, every dollar matters. They're saving over $3,000 a year in taxes, not by giving extra or doing anything different other than changing how they give to charity through a qualified charitable distribution. Now, bringing this into the present, maybe right now you are not at the age where you can make a qualified charitable distribution. You are younger than 70 and a half. Your spouse, you and your spouse, if you're married, you're both younger than 70 and a half. So how can this impact your financial planning earlier in retirement or even pre-retirement? One of the things that I think is really important to note here is that it's very popular, and there's a lot of benefits to doing something called a Roth conversion, which is taking money out of your pre-tax accounts, retirement accounts, and paying taxes on it to shift it over into a Roth account. There's a lot of reasons why this is a good strategy, and it can make a lot of sense. This is just something to take into account. If you are a retiree who, or you're just a person, I should say, who likes to give to charity, it's just something you do, you give to your church, you give to the food bank, whatever it is that you do, and you think that it's something you're going to continue to do later on in life while you're retired, then even if there's a good financial reason to do Roth conversions now, it's going to make sense to not convert everything over to a Roth, because if you do that, then you're going to pay taxes on that money. Whereas if you keep some of that money tax deferred in a pre-retirement account like a 401k or IRA, you will have the ability to take that money out tax-free, never pay taxes on it, to pay something that you were going to do anyway, in this case talking about charity. So this is just another thing that is very helpful as you are thinking about your retirement, whether you're getting close or you're in retirement. If you haven't done this before and you're already this age, you can still do it. It's not like you did this once and you have to keep doing it or whatever. This is something you could do and then not do from a year-to-year basis. So maybe one last thing that'll share in this video is that doing a qualified charitable distribution does go against your RMD. So this is why it's particularly powerful. If you have a required minimum distribution from your IRA, let's say it's $20,000 a year, you could do a QCD of $10,000, and then your RMD would just have to be the remainder. So in this scenario, it's $20,000. Then you would take out $10,000 for your QCD for charity, and then $10,000 more, and that takes care of your required minimum distribution. So this is where it can be a powerful planning tool later on in retirement. But even if you're not there, like I said, it can impact your planning decisions you make pre-retirement or just earlier in retirement. So hopefully this has been helpful. Please leave me some comments. If you have any questions, I'd love to do some follow-up videos on this topic. I know there's a lot of questions about this. If you live in a different state and you'd like me to look at, what would this scenario look like in your state, or with different income numbers, slightly different, income sources and that sort of thing, be happy to make another video to be able to share with everybody. So, until next time, take it easy.